Howdy, Jacob here. Today we're looking at Dorian, ticker symbol LPG. All right, so it's in the oil, gas, and consumable fuels industry. It looks like they do transportation through their LPG tankers. $1.9 billion market cap, $2.2 billion enterprise value. Not so much net debt there. Currently 8.7% dividend yield. That's a good amount. That's a big dividend. Looks like if we look at their history, they've only been paying a dividend for two years now. That's not a whole lot of data to be working off of, but their cash flow has consistently been positive since 2016. So that's definitely a positive. And let's look at their balance sheet. So $600 million, sorry, in debt, long-term debt. That is, I mean, let's see, 5-year average, 100, So that's not an excruciating amount of debt here. And it looks like the company, oh my gosh, everything they make, at least in the 2 years that they have produced cash flow, they have used a lot of their money to pay a dividend. And so this is going to be one of those other companies, just like this is going to be similar to that one of the other companies, a lot of the other companies we looked at in the oil and gas industry, where it's a seasonal business where when money's hot, they will send out a lot of money to their shareholders. And when it's not, they don't pay a dividend or they don't pay a big one. It's all just dependent on their free cash flow. So, again, there's just not a lot of history here. So, I think I'm going to land on the conservative end here and say $162 million payout is probably too much. They cut that in half. It is still a 4.365% dividend, so still a very hefty dividend over the 4% that we're looking for. But we want history in our dividend. If we're looking for a company for dividend purposes to get excess cash flow in our retirement or whatever need we're looking for, we want companies with a long history of dividends, and that's not what we're seeing here. So this could be something if we research, maybe they switch management and this new management is historically known for dividends. But as of right now, without doing that, we can't be too confident that the dividend's going to hold forever. I would say this is one of those companies that I'm going to do 0% on the revenue growth, 10 on the PE price free cash flow for no growth business, maybe 25 and 35 for margins, and then no share changes. I might do, let's say they buy back 0.5% of shares. At this rate, we're still seeing that the company would need to fall 48% to get us to the 50% return that we're looking for. Again, a company that we're looking for in dividends has a long history of them. But the other cases, this company is almost, checking all the boxes for. Debt isn't excruciating. We're looking at roughly 5 times long-term debt. Their 5-year average free cash flow 5 times that for their long-term debt. That's not too concerning, but again, we're looking at more recently where oil and gas has historically been higher than, or has been higher than historical figures. So we could just be seeing the more peak of the numbers, but even still, we like to see that since 2016 they've produced positive free cash flow. That's definitely a glowing portion of what I'm thinking about it. And then they have bought back shares. Now I don't know if these are cheap shares. We'd have to look at the business when they bought back these shares. Was that at a good time? So it's not necessarily saying if a company's buying back shares that's great for everybody. It's not true. It has to do with the return that they're giving you as the shareholder. Because as a shareholder, you own a part of the free cash flow in the business, and so if they're using their free cash flow to buy back shares, you want to make sure they're buying them at a cheap price so that they're giving you the best return with your money that they can. And so for now, I think we're just waiting on the company to get to a price that's more attractive to do further research. But until then, hope everyone has a good rest of their day, and thank you so much.